Okay, hi everybody. Welcome to Fixing Fixed Income, the last part of our Fall National Tour 2019. I've talked about the problem with fixed income markets for a number of years now on BNN, and hopefully after today's webinar, we'll have time for some Q&A at the end and at the beginning. We've got a couple guests on. We've got Bobby Argetis from National Bank, who's going to tell us a little bit about the National Bank online services. And we've got Mark Hadhad from BMO, who's going to tell us a little bit more about BMO ETFs. So, with that in mind, I do want to give a special shout out to all our sponsors, because without them, these roadshow events that I do for BNN across Canada would not be possible. So thanks to all of our sponsors, and a special note here, I talk about it on BNN quite often. All these events that we do, either webinars or the live events, are all free, and in thanks because of our sponsors. And we do ask that people make a donation to Alzheimer's and dementia research at the Baycrest Hospital here in Toronto, or to cancer research for kids at the Sick Kids Hospital in Toronto. Okay, up now, I'll turn it over to Bobby and have him take us through what National Bank direct brokerage is all about, and some exciting news from them. So take it away, Bobby.
Perfect. Thank you very much, Larry. So good afternoon, everyone, and thank you for joining us. Off the bat, I really want to thank Larry and his team for organizing this event. So, I think I'll start off. So can I change the page here? All right, so to start off, I want to show you some of the research available for our clients to use, specifically on ETFs, and later on certain investment tools. Some will be ETF specific, while others stock specific, and some will be interchangeable. Since we will begin with ETFs, I wanted to inform you that clients who do business with us benefit from zero commissions on Canadian and US listed ETFs. Basically, if you buy or sell a minimum of 100 shares and you trade online and are set up to receive all your documents electronically, no commission will be charged on the transaction. This is not a promotion. It's been the case since September of 2017, and this is basically how we choose to distinguish ourselves in the industry. Now, for investors who want, let's say, fundamental research on ETFs, we provide you access to National Bank Financial Research. This research is the same that our full-service advisors have access to. An example of one of the type of reports is shown here, where we've grouped ETFs by strategy. So I'm just going to show you one of the slides. So for example, we can have large cap, there's income. For example, some of these strategies are a little more well known. Others are a little more niche. So for example, if you're looking for, let's say, ESG, environmental, social, governmental, basically ethical ETFs. There's on top, you'll see blockchain. There's infrastructure. There's even a section, for example, for clients who are looking for, let's say, for covered call ETFs. So, with all the different categories of ETFs and the strategies they employ, essentially a regular ETF filter might not have the specific criteria you're looking for. The goal here is to help you find what you're looking for without missing out on your ETF. So let's say now you've gone through the list here and you've chosen a few ETFs. We even have a tool that you can use to compare them. So I'm just going to change slides. You can find the comparison tool in the drop-down menu of the toolbox, and that's called Compare. And basically, you can compare mutual funds and stocks using this same tool up to a maximum of 4. So in our case, we're going to go for ETFs, obviously. So in here, I've got 4 different ETFs. Now, Let's say the first one here, we'll look at the overview section where it's, the information is very straightforward. Last price, the equity class, the benchmark, and the management fee for each one of them. The next section that clients really do appreciate is the performance section. So again, depending on how long the ETF's been there, you'll have up to 10 years of return. So it's very easy to compare the ETFs. And then there's the top 10 holdings section. This one here, obviously, it's not really necessarily a day trader's information, but let's say, for example, you're already holding shares of XIU, and you wanted to add some dividend-focused ETFs. So let's say the Vanguard here, the VDY. So off the bat, you can quickly see that you're not really diversifying yourself. You're adding a lot of the same types of stocks into your portfolio. So it's an easy way for an investor to see what's going on within their ETFs. Now, for those of you who are a little more visual in terms of the returns, we can show the returns in chart format by looking at by clicking on the following button, where here's just sort of a graph. And basically, depending on your time horizon, we can go long term. For example, I put here 2 years, or you can modify the graph to go short term if you're looking more see the short term fluctuation. This graph really, you can modify to your heart's content. I could put candlesticks if I wanted to. If I could add extra reports. Let's say, for example, if I was looking for the MACD, or let's say I could put in moving averages. So there's a lot of opportunity for you as an investor to modify the chart to see what you're looking for. Now, let's say I wanted a detailed quote on one of the specific ETFs. Let's say the XIU. Then I can simply click on the symbol, be over here, and I'll be redirected to our quote page, where I can refresh the quote by clicking on the following right here. Now, since we're already in the quote section, let me show you how what a trade ticket looks like with us. So basically, as you can see, we've got buy and sell buttons a little bit all over in the page and throughout the website for you to use. So by clicking on the buy button, you can see our standard trade ticket will appear, which can be changed into a slimmed down version by clicking on the double arrows over here. Now, if you prefer to use your smartphone or simply want to free up real estate on your page, or sorry, not real estate, but we want to free up space on your screen, this version will certainly appeal to you. It can be moved around the screen or even minimized as you navigate the different sections of our website. So again, when you're ready to trade, you can just pop it back open. Now, obviously, you can also trade mutual funds, options, and obviously stocks the same way. Now, since I brought up stocks, we have a tool that many of our clients appreciate, which is called Strategy Builder. It's part of the Rakaya toolkit. Now, this tool is tailored for those looking to invest in equities. It's similar to a stock filter, but you can include technical analysis filters as well. It has over 100 different criteria that you can choose from, and allows you to backtest your strategy to see how it holds up. It's really the backtesting which most clients appreciate. So let's just, I'll go through a quick example here. So in this case here, I've chosen that I want stocks that are on the TSX. I've chosen ahead of time, I'm looking for dividend yield between 4 and 7%. Earnings per share growth, I put between 5 and 15. Dividend growth rates. And so I've got, here, so it's giving me exactly 13 choices. And by scrolling down the page, I've got them here. So these are the different categories. Now, let's say, for example, after looking at this, I want to look at the performance. So if I click on the performance tab, I'll be able to get, my apologies, did I skip a section? Yeah, you know what, there's a performance tab, but then the performance tab would end up calculating the return on the portfolio. So obviously, if the returns look decent, then you might want to use the strategy. If not, you would move on. So let's say I'm looking to I'd like to find more information on one of the stocks, which was CIBC. So by clicking on it, I'll get the quote. Now this is this section. I'll be able to get the quote information. As you can see, I also have basic information. So from National Bank Financial, they rated as a sector perform. With Morningstar, I've got a 4 out of 5 stars, which is considered very good. And with Zacks, I've got a hold. Now, if I want to get a little more information, I could click on this or scroll down the page, the analysis section. Here I can get some additional information. I can actually get the numbers. So National Bank Financial sees it at a price target of 110. It was 111. Morningstar sees it at 125. And again, Zach still has it as a hold. Now, in this case, National Bank Financial and Morningstar, they have a diverging view of it. In that case, we can also, let's say we wanted another opinion. Another tool offered by Rakanya is called Value Analyzer, which is up over here. Now, Value Analyzer uses quantitative, this is where my slide went. Sorry about that, people. Value Analyzer uses quantitative analysis to give you a recommendation. It's very straightforward. It's almost like the street lights. So green, it's a buy. Yellow is, maybe hold off, and red is to stay away. This tool is for equities only, and works best for established companies with earnings. And in our case over here, they see it as fairly valued. So let's say even after this, we're still interested in purchasing the stock, but we'd like to see what the technical analysis has to say on this idea. So if we click on Technical Insight, it'll say what it'll say what it shows us. So by clicking on Technical Insight, the stock here has 22 technical events. Some of them bearish, some of them bullish, and it's been broken down into different categories. So I can go at short term, intermediate, and long term. What's also nice about this is that you can also add an extra layer. So you can, by clicking on More Analysis, you can compare the stock compared, let's say, to its index, the financial services index, or for example, how the TSX is doing to get a broader view of what's going on. Now, obviously, Technical Insight can also be used with ETFs, which is what you're looking for. Now, near the beginning, I spoke about our pricing on ETFs, but I also like to inform you of our pricing on stocks. So our regular price is $9.95 on stocks, but if you happen to be an active investor, and for us, that's someone who does 100 more trades a quarter, this drops to 95 cents. It's not a typo, it's at 95 cents. And if you happen to be a young investor, essentially someone who's under the age of 30, or someone who is, we offer a pricing of $4.95 a trade. But the first 10 trades every year are on the house. So we essentially cover your first 10 trades. And after that, the rest would be at $4.95. And finally, if you happen to be a National Bank client and you have a bank account with us linked to your brokerage account, well, we offer you a reduced pricing of $6.95. So these are the different pricings, and obviously the free ETF offers is also good with these as well. Now, before wrapping up, I'd like to show you our YouTube page, which offers our clients several how-to videos in order to get comfortable with our website. The video that appears on top actually will show you the tools that I talked about before, as well as others that are available. So for 70 seconds, you'll get to see my 10 minutes here. And now for those of you who trade regularly, we also have several videos on how to fine-tune our active trader tool, which is called Market Q. So it's over here. And lastly, we also offer a section of training videos from the TMX that explains how to use options, how options work, the different strategies available to you. So this section here, we're constantly feeding it with new videos. This snapshot was taken about 2 months ago. If you were actually to visit our site, you'd see that there's been a few more that have been added. But investor education is something we're very serious about over here, and this is how we choose to help our clients. Now, this essentially concludes my portion of the presentation. If you have any questions, don't hesitate to reach out to us at direct brokerage at nbc.ca. And on that note, I'd like to thank you again for listening, and happy holidays. And Larry, it's all yours now.
Okay, great. Thanks very much, Bobby. A couple questions just came in, and I think you cleared up some of the answers to that in your talk today. All those tools are fantastic. It makes me think people are going to stop watching BermansCall with all the tools out there that people can use to help make themselves better investment decisions. Okay, we're up now with BMO to talk about BMO ETFs and do a little education before I get going with the presentation. So Mark from BMO, please take it away. You have control.
Good afternoon. Thank you very much. So as Larry mentioned, my name is Mark Hodhod from BMO Exchange Traded Funds. So money is important. We all work hard to earn a living, and this is why it's important to ensure that we are invested right and we make it work hard for us. So before I hand it back to Larry, I just wanted to provide you with some insights on ETFs based on the research we've done with direct investors. So investors have been integrating ETFs more and more into their portfolios as they recognize the many benefits associated with them, such as the low cost, transparency, tax efficiency, and diversification. You know, this summer has marked BMO's 10th anniversary in the ETF industry. We are proud to say that we've been leading the way with many innovations that have added value when building a portfolio. In fact, over the last 8 years, we've been #1 in terms of net new assets amongst all ETF providers, and we now stand with approximately 30% market share. So we're very proud of that. Thank you all for your support. We would not be where we are today without focusing on investor education and resources. So on our website, you can find some great tools which allow you to better manage your investments. For example, our comparison tool allows you to run a side-by-side comparison of any Canadian-listed ETF or mutual fund. We also have a portfolio builder, which allows you to create your own portfolios and analyze the performance and other important statistics. Lastly, we have the BMO ETF dashboard. This is a separate website which allows you to find monthly trade ideas, methodologies to our products, as well as plenty of educational material. If you haven't already visited the dashboard, the website is right at the bottom of your screen, www.bmoetfs.ca. I encourage you to all check it out. Now let's have a look at some considerations for direct investors. So this is actually coming from a report from Polaris Strategic Insight. And what we found is that, first off, Canadians are leaving too much money on the sidelines. Some have as much as 50% cash in their portfolios. You know, this much cash on the side can cause a cash drag to your portfolio and can cause you to risk falling short of your investment objectives. We understand this might be related to liquidity concerns or potentially having enough cash to make the right purchase, but investors should be aware of the consequences. Secondly, over-concentration is another consideration. So whether it's due to trends in the market, such as investing in your favorite stock, perhaps a marijuana stock, or simply being overweight a particular area, such as Canadian equities, diversification is key, and many investors often forget about this. Helping one to be liquid, fully invested, diversified is what an ETF can do to help complement your portfolio. So to demonstrate this, what we did is actually built 3 hypothetical portfolios. We'll start with the middle portfolio. This is an all-stock portfolio consisting of just 5 stocks. It's an example of how a portfolio might be lacking diversification. Now, just to remind you, these are just popular stocks that we've chosen. There's just an example. So on the left-hand side, you will see that same 5-stock portfolio. However, 50% is now invested in cash. So this would be an example of how a portfolio might be overweight to cash. And finally, on the right-hand side, what we've done is we've used the same 5-stock portfolio. However, this time, we've invested the remaining 50% in ZGROW. This is BMO's growth ETF, which is an 80% equity, 20% fixed income solution. So to demonstrate performance, we've taken those 3 portfolios and we went back over 3 years just to see the performance of the 3 portfolios. You will see that portfolio number 3, which is represented by the green line, has performed best amongst the 3 portfolios, and it has also demonstrated less risk when compared to the original 5-stock portfolio. Now, granted, in late 2015, early 2016, there was a market drop. So we've actually run the numbers to omit this drop in the markets. You'll see portfolio 3, which is, again, the green line, has performed well, not as well as the 5-stock portfolio. But what I will point out is the reduction in volatility. You will see that green line is much more smooth in terms of its return path, and it also allows full market participation when compared to that 50% cash portfolio. So although this is a very simplistic example, it shows how an investor can easily integrate an ETF into their portfolio, such as ZGROW, to complement the portfolio, provide liquidity, diversification, all while remaining invested. So in case you're not familiar with these asset allocation portfolios, we have a little bit more information here on them. Just waiting for the slide to switch over. So basically, these portfolios allow investors to gain exposure to a broad set of indices with just a one-ticket solution. So they're usually offered in various preset asset allocations, but I would say that the common ones are conservative, balanced, and growth. So conservative is a 40% equity, 60% fixed income. Balanced would be the reverse, so 60% equity, 40% fixed income. And lastly, growth, as we mentioned earlier, is an 80% equity, 20% fixed income. Now, what are the benefits to these portfolios is they're very low cost in nature, ranging from 18 to 22 basis points. I will highlight BMO's tickers, which are ZCON, ZBAL, and ZGROW, and that BMO is amongst the lowest costing of all providers in this space at just 18 basis points management fee. Lastly, these portfolios are very strategic in nature. So if you're looking for more of an active approach or perhaps a tactical mandate, you can look to the BMO Tactical Dividend ETF Fund. We call it the Sleep at Night portfolio, which is why the ticker is ZZZD. This one is actually managed by Larry himself. And in this portfolio, Larry will manage the risk in the portfolio based on the risk in the markets and the opportunities that he sees. So it has a very low level of risk, and it could be a good complement to diversify a portfolio. So I hope this has helped to show you how ETFs can make great tools to complement your portfolio. Without further ado, I will pass it back to Larry for his Fixing Fixed Income presentation, and I thank you all for your time and attention.
Thanks very much, Mark, for that. I like these three ETFs a lot, and you can trade them for free at National Bank now. But how much risk you should take in your portfolio and trying to time markets is a very, very difficult way to think about it. Your portfolios could be as simple as when you're concerned about the markets, you go to a more conservative type portfolio with a ZCON, gives you 40% equity, 60% bonds. And when you want to be more aggressive, you go to a ZGRO and have 80% equities and 20% bonds. And if you're not sure, somewhere in the middle with a ZBAL. The three ETFs, they're 18 basis points each. And a lot of the ETF providers do have similar type portfolios. BMO's do have the lowest MER. And of course, with National Bank now, you can trade them for free. So you got the best of both worlds, and your portfolios can be that simple. The difficult part, folks, about all those three portfolios is that they have some degree of fixed income in them. And that's the topic of today's presentation, fixing fixed income. So I'm going to talk a little bit about, what money is and lending and interest rates, and give you a bit of the history of fixed income and inflation, because bonds and inflation are tied in dramatically. And I talked about some of the impacts of monetary and fiscal policies on interest rates, and ultimately try to determine, how to what degree you should be using bonds. Then I want to go into the portfolio side of things and gives you some ideas on strategies on how to go about this difficult world of fixed income, and I'm going to talk a lot about options, and it could be very, very difficult for some people with these option strategies. But generic fixed income, basic being long fixed income, it's not going to work in the future. And the main reason it's not going to work is because if you take all the bond yields in the world and kind of average them all up, the yield to maturity of the world is about 1.5%, a little bit less than that. And the global inflation rate is running north of 2%. So you have the entire world of fixed income that has a negative real return. So a couple of considerations when you're thinking about fixed income, and the primary one is, are you going to get your money back? So we have these thing called credit ratings, and there's some few credit rating agencies. There's others. These are some of the major ones in the U.S. And you have the concept of good companies and bad companies. So we call it investment grade, or you have a much higher probability of getting your money back, or non-investment grade, what we also call junk bonds or high yield. It's some of the weaker companies. I have an example of a bond here at the bottom that was issued a few years ago. It had a 5.5% coupon, basically 5.3 to be exact. And it matures in 2025. And so you can see, and that's actually Tesla issue. And as Tesla has come under stress in recent times, the bond yield that was issued at 5.3 jumped up to over 9%. And that's the challenge with high yield, because as the yield rises, price of those bonds fall considerably. Tesla is a triple C rated company. And what I like to say, crap in terms of its rating. So, the worse the credit rating, the more or less likely it is they're going to be able to pay you back. But even in the investment grade world, one of the effects of this low rate world we're in is that about a third of the S&P 500 companies are sitting at this triple B rating. And in the next economic downturn, whenever that is, the next year or two, certainly, a lot of these companies, somewhere between 50 and 100 of the S&P 500 companies, are going to be downgraded to junk status. Those of the companies that have been loading up their balance sheets to buy back equities at all-time highs are going to have a difficult situation refinancing some of that debt that has pushed their credit rating lower, and ultimately are going to have to issue equity and dilute the shareholder to pay back those bondholders. So we're in for a credit problem at some point. Again, when that happens is very, very hard to say. So the world of fixed income can be the highest credit rating. Governments these days can print money and pay you back. Historically, the currency was backed by gold. We came off the gold standard years ago, and just having some technical difficulties here for a second, folks. Not sure what happened here, but we'll get it up again here. There we go. Okay, should take a minute here for screens to clear. And I don't see, there we go. Here we're back. Sorry about that, folks. Okay, so, getting back to, money used to be backed by gold, and it was harder for governments to increase the money supply and print money. And today, this fiat system, quantitative easing, the era of low interest rates. It's not in gold we trust, it's in God we trust. And I kind of make a little bit of a joke about it. And by no means am I a gold bug, but this low rate environment is actually very, very bullish for gold. And I consider precious metals part of the world of fixed income. The challenge, of course, with precious metals is that there's no yield in your portfolio. And that's a big issue. So a long time ago, the first Treasury Secretary of the United States was Alexander Hamilton. He's very famous for lots of quotes, but one of them is, "A national debt, if it's not excessive, will be to us a national blessing. It will be a powerful cement of our union." So what he was talking about is the government's ability to borrow money and spend it to stimulate the economy and put people to work and those kind of things was a blessing. But what people knew a long time ago was ultimately you have to pay the debt back, and turns out governments just haven't been very good at that, and I'll speak to that some more. This book recommendation here for everybody this time is different. It's 800 years of debt and debasement of currencies and default. It was written by a couple of U.S. professors. It's a dry book, but I think an important read for a lot of people. So if you do have trouble sleeping at night, the book is highly recommended to help you with that. The graphic here is taking us back to the mid 1800s in terms of the recession, but really back to the U.S. Revolution and the Declaration of Independence and the beginning really of the U.S. economy. Prior to the 1850s, they didn't really keep track of recessions or the economy very well. But all the gray shaded areas are recessions. And we can see the cycle of interest rates there. It's very, very interesting. The normalized kind of rate for a 10-year bond yield in the U.S. is about 5%. You can see that we've spent years above, years below, years above, years below. I think ultimately in the next economic downturn, yields are going to continue to fall here. About a year ago, Jamie Dimon, who's head of JP Morgan, you should all know that name very well, said on a conference call that he expected the U.S. 10-year rate to normalize at around 5%. And literally, I fell off my chair laughing. So if you go back in the chart here, I blew up the last part of that chart for the last couple of years, because when I found this graphic, it ended around the Brexit time there a few years ago. And so I blew up the chart with the scale just on the right there. And you can see the U.S. 10-year rate jumped above 3. And that was about the time where Jamie Dimon said, we think the 10-year rate's going to go to 5%. And I get why he said that, because that's kind of the long-term average. But in the economy we live in today, a 5% 10-year rate to me would imply half the number of car sales and a third of the number of home sales, because no one can afford it. And so that's never going to happen, because the economy would just tank. And this is one of the reasons why every time we've seen bond yields go up and down and up and down, up and down, it's always been to a lower low and a lower high in terms of yields, coming off the 40-year period almost now, where inflation peaked in the early 1980s. Fed Chairman Paul Volcker, who passed away this week, was responsible for Fed policy back then and raised short-term interest rates to 20% to kill the inflation spike of the 1960s and 70s. So inflation is a big part of fixed income overall. And so no view of fixed income would be complete without a commensurate view of inflation. And again, I focus on the U.S. market because basically that's half the world and it's the biggest economy in the world, and everything else is a spread to the U.S. market, i.e. outperforming or underperforming. So when we look at inflation, we see during weak economic times and recessions, inflationary pressures come down. And of course, when the economy's hot, inflation pressures kind of rise. But you'll notice something interesting over the last, 20, 30, 40 years, in that each peak in inflation has been to a lower level, commensurate with the lower highs that we've seen in fixed income yields and inflation overall. So, we are in this era of low inflation rates, and I don't see it changing anytime soon. Now, there are different types of inflation. There's good inflation. So, good inflation is when wages are going up and demand for products are going up because the economy's hot. Every recession that we've had highlighted on the graphic here since the creation of the Federal Reserve was largely due to the Fed tightening rates to slow the economy down and to curb inflation pressures late in the business cycle. Except this time around, they were able only to raise interest rates 225 basis points, where in past cycles it was north of 500 basis points before they killed that inflation spike. Never mind the 20% short-term interest rates we had in the late 1970s and early 1980s to really kill inflation back then. So why is this time different? Why is it so weak? Well, it has a lot to do with demographics. When we've seen spikes in inflation over the last couple of years, it's generally been of the supply shock type, i.e. oil prices squeezing higher because there's some shortage of supply, for example, and typically coming out of the OPEC nations. So again, there's good inflation, there's bad inflation, but the reason inflation hasn't come back, generally speaking, is that incomes, so median household income in the United States adjusted for inflation, hasn't gone up in about 40 years. And folks, that's why Donald Trump is president, because he's a brilliant marketer and he said he's going to make America great again. And the reality is it's no better today, despite the fact that he's telling us that, it is, than it was 3 years ago. Median household incomes are not going up, adjusted for inflation. So it's getting worse. Inequality is increasing, separation of class. All these policies, monetary and fiscal, designed to boost the economy are boosting it. But we've basically run a 5% deficit annually, if you smooth out the data, since the Lehman moment. And we've managed 2% growth rates in the U.S. This is the worst economy in history, not the best. Has nothing to do with Donald Trump, by the way. Although in the last couple of years, since he's implemented these tariffs, a lot of the global slowdown has a lot to do with Donald Trump. But I want to look at the front edge, the leading edge of this, because it's Japan. And the Japan experience over the last, again, 20 plus years, the red line on the chart there is when Japan started doing quantitative easing. And it really hasn't worked. And they're just starting to develop a narrative and saying, we've been trying this for a long time and it's really not moving the needle. So when you look at Japan and you say, well, why hasn't any of this worked in Japan? And you say, why? Well, the answer is pretty simple. They're the oldest economy in the world. And what I mean by that is the average citizen in Japan is about 47 years old, as measured by the World Bank database. And so that's the oldest. Germany is about 46. North America is about 40. China is about 42, I believe. And so the developed world plus China is actually quite old. There's parts of the world that are very, very young. So in North America, the average woman's having 1.7 kids and is 40 years old. You do the math, where compared to India, where the average woman is in her early 20s having more than 3 kids, or a place like Nigeria, where the average woman is in her late teens having almost 5 children. Where's the population growth going to come from? The natural rate of growth of an economy is this thing called population growth, the natural rate of growth. How many people are living there, and how many people are working, and how many people are earning income. That's the natural rate of growth. 2, augmented by increase in real wages, so more real income, and productivity, the output that these workers are producing for every hour they work. So output, unit labor cost, basically. And so technology comes along, and you had the breakthrough of the microchip, for example, 70, 80 years ago. And the productivity boost we got was dramatic. And so when we look at the TV in the window, we say, wow, it's $4.99 today. But you know what? On Boxing Day, it's going to be $3.99. And in January, it's probably going to be $2.99 because the next year's models coming out, and they heavily discount the old models to get rid of them. And so that's the mindset of the average person today. And so until you're capable of spending more and willing to spend more, you don't. And then there's your life stage. When you're the 25-year-old version of yourself and interest rates get put to very low rates, you probably buy a bigger house and a nicer car if you can afford it, because the lower rates make things more affordable, as we know. So we've had a generation of low rates now, and it's boosted real estate and all these other prices, and it's actually making it wholly unaffordable. I've got 3 millennials myself, and I don't know how they're ever going to be able to afford a house in Toronto if it were not for the bank of mom and dad. But having the bank of mom and dad is a luxury item. It's certainly not everybody, and let's call it the top 20% of the population have that luxury. Certainly a luxury I never had, having grown up in poverty. And so, when you're the 60-year-old version of yourself and interest rates get put to zero, and you sit down with your financial planning professional and they model you out and they say, Mr. and Mrs. Smith, well, you're both 60, and the actuarial tables say one of you is probably going to live to 95. So, you've got X amount of dollars saved up, and here's what that looks like. And so they model in an inflation rate of somewhere 2 or 3%, and they say, how much does your savings need to earn you over the rest of your life while you're not working, and so you only have your CPP and OAS if you're eligible for that, plus what you earn on your investments. And maybe you monetize your house at some point, and that could help for some people. But basically, the top third have exposure to the wealth effect, and the bottom half don't. And it's not going to get any better anytime soon with the policies of low interest rates, because it boosts capital markets and people with wealth, and it hurts the savers. So when you're 60 years old and money gets put to zero, you say, oh my God, Larry, what ETF can I buy that gives me a higher yield than GICs? Because after inflation, I don't have enough. And that's the problem. And so Japan's the poster child for that. And they've tried all these policies for 20 years now, and they're not working. And I think the world's starting to realize that these low-rate policies aren't going to work. So, we've got to do something else. And what are some of those other things? Well, Milton Friedman is the godfather, if you will, of money supply and interest rates. And he wrote some seminal works and Nobel Prize winners. And basically, the system of the Federal Reserve system we have today are really governed after a lot of his thought in moving interest rates around. So the new way of thinking is more towards what I think ultimately will be debt monetization. So, the size of the Fed balance sheet, so the cash that the Fed creates to control the fiat system and the lending. So if you understand the basics of a bank, you put your money in the bank, and for every dollar on deposit, they can lend out a multiple of that. And it's the credit cycle that has the expansion and contraction of the business cycle. So you've got everybody's incomes, and those are pretty stable across time until people start losing their jobs. But generally speaking, somewhere near full employment where the economy is, that's pretty stable. And so how does the business cycle of this extra growth come? Well, it comes from credit. It comes from companies borrowing money to build new plant and equipment. It comes from individual credit lines and credit cards. And then when the economy slows down and people start losing their job, credit contracts and the cycle turns down, and that's typically what a recession is. But when the Lehman moment happened more than a decade ago now, the size of the Fed balance sheet on an emergency basis had to expand exponentially. And it's the demand for liquidity and money that caused all of that. And so QE, folks, is a permanent part of the world we live in. They had a problem in the repo market. I talked a little bit about it on this week's show recently, and frankly, that problem isn't going to go away. And so QE is now back on the agenda. The Fed's calling it non-QE, QE. But when they go out and physically buy securities and inject them into the system because the system needs the liquidity either to lend out or just because there's high demand for cash and liquidity, that's part of the new world we live in. So there's a narrative now that these low rates aren't working, and what we're doing to drive growth by way of interest rates are not working. So the new narrative is starting to say, well, we need more fiscal policy. And so introducing John Maynard Keynes, who's the godfather of fiscal policy, and he wrote some brilliant work and papers, and the general theory, again, is one of those seminal books that everyone needs to read in terms of how we should govern ourselves around spending. But when we look at the components of GDP, the consumer is the last thing to go. So the consumption part, which is our incomes being spent for consumer consumptions, and then government spending. Those two things are still firing on all cylinders, generally speaking, because we're at full employment and the governments are running massive deficits at all levels. All governments everywhere are basically doing that. But the cyclical stuff, the stuff that's more sensitive to short-term swings in interest rates, like CapEx, for example, and housing, have already turned negative the last couple of quarters. So we've got a couple components of GDP already in recession. The inventory changes in inventories you can see come in and out as factors. So, for example, demand for auto sales goes up one quarter, so the next quarter they produce a lot more cars, and if they don't sell them, inventory levels rise. It's the production of the cars that boosts GDP, but if the final sales don't come, GDP then shrinks because you don't get that final sale, and all you've created is inventory, which is production, but it's not final demand. And then the next quarter, therefore, in order to reduce those inventories, they produce less, and that's when the recession in that part comes. And when people start to lose their jobs, they cut back. And what Keynes said was that when the consumer comes back, the government should run deficits and should boost it by unemployment insurance and putting people back to work, shovel-ready projects, et cetera, et cetera. But he said when times were good, government should pay it back so they have money to spend. And the problem is the debt levels in the world, at every government, everywhere in the world. Anybody who says they're not in this situation is an outright liar. Now, you will hear from the government of Canada that federally debt to GDP is a little bit under 30%. And while that's true, that's only true because of the restructuring of transfer payments to the provinces and downloading the debt on the provinces as part of what Paul Martin did many years ago, and subsequent governments have downloaded more burden to the provinces. And so when you take the provincial debt and federal debt and looked at that as a percentage of GDP in Canada, it's over 90%. And, frankly, we're in the class of the worst debtors in the world. Ontario, if it was a sub-sovereign nation, would be absolutely the worst economy in the world by far, like, magnitude of Greece bad and Italy bad in terms of the debt outstanding. But Ontario actually can't go out and create money and buy those bonds back. So the future of money, a little bit on that before I get into the portfolio side of things. I believe one of the solutions is ultimately digital money. It'll get rid of the gray economy. It'll make things far more efficient. It's not going to be, I will stake my reputation and career on it, practically speaking. It's not going to be an independent currency. The money supply in the worldview that I have is always going to be controlled by the central banks. And so it'll be digital. Bitcoin and stuff like it might exist, but I do believe ultimately it gets legislated away. The blockchain technology, however, is brilliant, and it's a game changer for many, many industries, from the legal profession right through the medical profession and so forth, and will likely be the engine powering the digital world in the future. But Bitcoin isn't money. It's not anything but a volatile asset that has more volatility than grapes and red peppers, for those of you who do the groceries in the household. And it's not money. So it is an asset. Can you trade it? To me, it's a speculative thing. And if you want to trade it, go for it. But the reality is it's ultimately the value of it. If you're saying, what is it worth? I think it's worth close to nothing. So a little bit on that, but ultimately I do believe within maybe 15 or 20 years, the entire world will be digital. There'll be black market will go away. The cocaine dealer will still sell his cocaine, but he'll sell it to you in a briefcase, and the briefcase will be, $1,000 or whatever cocaine will cost for that amount. And then it'll be taxed, and it'll be taxed as a briefcase. But what you get in return is something different. So let's move on to the investment side of things. And ultimately, when's this next recession coming, Larry? Because you've been talking about it for a number of years now, and it hasn't come. And the answer is the yield curve, the cost of money. So when short-term rates are above long-term rates, and we've recently seen an inversion in the yield curve, both here in Canada and in the U.S., despite the fact that the U.S. curve is not inverted at the moment, because the Fed's already started to cut rates. Nevertheless, it's not that. The policy transmission of tightening policy takes a while to move its way through the economy. If you add that up with the tariff war that President Trump has started and is going to continue, unless a year from now there's no tariffs at all, and I mean forget not raising tariffs, I mean no tariffs at all, and they're not a policy tool of the administration, the global economy will be in a worse shape than it is today. I virtually, I would say can't guarantee it, but I virtually guarantee it, just because of the problem that these tariffs create. And I get why he's trying to do it, and I get why he's trying to bring China to the table, and I applaud all of that, because China really has had an unfair advantage for a long time. I'm not sure tariffs are going to fix that. And so we got to get rid of them as fast as we can for the global economy to recover. But what I see here is people getting more nationalized. I see the whole part of the deflation of the last 40 years is globalization. And I see an unwinding of that under President Trump and other governments that are getting more nationalistic. And I think all that is inflationary and bad for global growth. So we're likely to see downgrades for global growth in the coming years. And those hoping for higher growth, it's all debt financed. If you take all the debt in the world that's come post Lehman and wipe that out and say debt to GDP globally had stayed the same, you're basically looking at a global economy with about 0.5% growth rate, which is basically a little bit under what the population growth is. Productivity globally has been somewhat anemic and falling for years and years and years as well. The money multipliers where governments borrow and spend money are certainly not what they used to be. The money multiplier of building a road and opening up a new community is not the same as the money it takes to fix that pothole or rebuild the hospital or the airport. The same money is being spent, but the productivity kicker of that investment is way down. So for lots of reasons, global growth rates are going to be slowing. They'll continue to slow. China is going to continue to slow. The only reason China is growing at this point is because they're stimulating and running massive deficits. So, in the future, it's going to be about, how do we pay for that debt? Because it's only the growth's coming from debt. So, enter the era of financial engineering. One of the low interest rate things, it makes money cheap. And so this study that was done by Deutsche Bank a couple months back, very interesting. It said, 20 years ago, what did they do in the C-suite with their free cash flow? So where did corporate profits go? And back then, most of the money went to CapEx, new plant and equipment, hiring more employees. And since we entered the era of ultra low interest rates, first after the tech bubble burst in 2000, and obviously in the last decade since the Great Recession, more and more of that money has gone into share buybacks, and it's the biggest growth area. And what that's done is artificially boosted earnings per share because it's cut the number of shares outstanding. So the earnings that we have today are not real earnings; they're financially engineered earnings, and the real growth rate is a lot less. So the markets today, in my view of the world, actually have never been more expensive. And you might argue that, well, interest rates are so low, Larry, and there's no alternative, so therefore stocks should have a higher valuation. And I don't disagree with that narrative. But my point is, when the next downturn comes and the valuations are high, at the trough of the recession, the valuations are low. And we are going to see a material correction in the stock market at some point. So the future of money and the world we live in is going to move more towards modern monetary theory. Milton Friedman first presented this idea in 1948, so it's not modern or it's not new, and it's not really much of a theory, but he wrote a paper and he said the alternative way of increasing the money supply as opposed to controlling interest rates is to just print it. And so, governments will agree that there's certain basic things that we should just increase the money supply for. So let's call that, certain policies like unemployment insurance. I think it would be all a good idea if we could pay for prescription medicine. How about university? How about higher education for everybody? On average, if you make everybody skill set a little bit stronger, in theory, you have a stronger and better economy and a better workforce. So that would be a good investment. So, let's take the basic things that centralized governments should support, and let's print money to do that and stop tinkering with interest rates, right? To control the business cycle. And but eventually all that money gets out there, inflation picks up, and the cup runneth over. And the way to control that or suck that money out would be issuing bonds at that point to pull the money out of the system, or to increase taxes as a way to pull the money out of the system. So I think we're heading to this world where Adriana Ocasio-Cortez in the U.S. and her Green New Deal that's going to cost trillions and trillions. Where's all this money coming from? You can't simply tax wealth, although some people might debate that you can. And certainly the more inequality we have, the more political split there's going to be in ideology between the left and the right. We're seeing this in every developed economy, and in fact in some emerging markets too in Eastern Europe, where you're having this nationalization, this split between the left and the right. Italy's got a coalition government with an extreme left and extreme right-wing party come together to govern. I mean, the world geopolitically has never been more fragile. So, you've got this state of the world where, to me, when I talk about sleep at night and safety in portfolios, it's how do you keep your money safe? So ultimately, debt monetization and printing money is the future. Alexander Hamilton, 9 years later, as Secretary Treasurer, said, "I ardently wish it to see it incorporated as a fundamental maximum in the system of public credit of the United States, so how much we owe, that the creation of debt should always be accompanied with the means of extinguishment." In other words, we got to pay it back, people. And everybody's known that. But now we're at the point where we can't pay it back. We are past the point of no return, because the only way to pay it back is with austerity. And no one will vote for that. You can't take the promises back. No one will support that. So the idea of balanced budgets in the future is only going to get harder and harder and harder. And governments that espouse that view, I get why they're doing it, but at the expense of economic growth is not going to be politically palatable. So we are going into a world where debt is just going to be monetized. And if every government is doing it, maybe that's just the way the future is going to evolve. And as a fiscal conservative, believe me, it makes me sick to my stomach to say something like that. So, let's talk about markets in the last half hour here. I always point out this cycle of market emotions. And if you take nothing else away from any talk that I ever do, understand that the point of maximum risk is when the past returns have been really great and the markets are at their high points. And the point of maximum opportunity on a forward-looking basis is when the markets have got absolutely pounded. So buy low, sell high is my mantra. Prospect theory was awarded the Nobel Prize in 2002, and it was developed by Daniel Kahneman and Amos Tversky in 1979, seminal research paper, which is the basis of the understanding of decisions people make about their money. So on the x-axis, you have gains and losses. On the y-axis, you have happiness or unhappiness, psychological value. So measuring your psychological value as you win money or lose money, and it doesn't matter whether it's in the casino of life, it's in your portfolio, or it's in a real casino. When your financial picture improves, you're happy about it, and when it worsens, you're unhappy. What they determined in their Nobel Prize winning work is that for small amounts of gains and losses, people have twice the degree of happiness as they have disgust with the same dollar value of loss. And as that dollar amount increases, your degree of happiness diminishes. It goes up, but at a slower rate. But the loss continues to increase until you can't sleep at night. And when it comes to the investment world and you're depressed and you look at your statements and they're all red and you're looking online and it's all bad, you get depressed about it, and that's when you capitulate. And every single market bottom is the same. Now, when I came across this theory, I overlaid it with what I knew about charts. I had been a classically trained technical analyst, first started looking at charts in the late 1980s, became a CMT, a chartered market technician, in the mid 1990s, and I was a school technical analyst. And in 2002, this theory changed the whole way I looked at the world, because it was okay to buy high and sell higher. It was okay to buy momentum, buy excitement, sell euphoria, no problem. But what I learned is if you want to sleep at night, you've got to take less risk when the risk factors are higher and more risk when there's blood in the streets. And the reason for it is prospect theory. It's how we behave emotionally. And the 99% of every decision we make in our investment accounts is emotional for everybody, including me. And I get this stuff and I've studied it and I know it. And everybody is linked to this cycle. And it's because we get a hormone release. When we're winning, we get a hormone release of dopamine, and we're literally getting high. We're getting happy. And when we're losing money, we get a release of adrenaline, and our heartbeat picks up, and we can't stop it. There's nothing we can do to control it. We can bring awareness to it, and we can understand our thought process, and we can take the emotional decision making and bring it into a cognitive, into the frontal lobe, where it's unemotional. And it's purely based on the mathematics of risk and return. And that's what we need to, that's where we need to get to. Now, historically, we would go to fixed income. We would move our money to bonds when we're worried about valuations and stocks. And the problem today with yields as low as they are is it's a lousy investment. It's a bad place to put your money. So the risk and return of safe money, government money, AAA money is anemic. And even when you move up the spectrum to investment grade bonds, still it doesn't provide a yield greater than in the inflation rate. And so therefore it moves you into equities and dividends and higher risky equities to generate that return. And the problem is the emotional ride, because it is thought that return and risk are linked, and it's not perfectly linear and proportional like the graph on the right shows with the red line. But the more risk you take, the more return you need to experience. But the reality is, for everybody, for most, is that you get a curve that looks like this blue line, meaning you only really need to take moderate risk to achieve your maximum output. And that, folks, is sleep at night. So I'm going to spend a little time within the world of fixed income showing you why that's the case. Now, the normal sloping yield curve is, banks borrowing short and lending long. And the spread between what they borrow at and what they lend at is their net interest margin and the profitability. The longer it takes for you to get your money back, the more risk you're taking. That's why the yield curve is normally sloped, so you demand a higher yield. Now, when the yield curve inverts and short-term rates are above long-term rates, not only are banks not profitable lending, that has always led to the business cycle contracting. Now, this cycle is very unique. It is like no others in history. And so it's hard to go back and say, well, this should happen. There's any number of scenarios where this economy can keep going with these free money and low interest rate policies for a long, long time before it ultimately breaks. But if Trump doesn't give up on these tariffs and the world continues to weaken because of them, which I'm in the camp of believing, eventually that recession's coming. And stocks don't trade at 20 times earnings in a recession. They trade at 12 times earnings. And simply doing the math, earnings contract 20% minimum In 2008-9, earnings contracted about 40%. So just by way of extremities. So 20% on average, multiple drops. So earnings that are about 160 now become 130, and the multiple's not 20 times, it's 12 times. 130 times 12, you do the math. We get a technical retest of the highs from 2000 and 2007, somewhere around 1600 on the S&P. Okay, so that's probably where we're heading to at some point when this ultimately all comes, undone. The only question is timing. So historically, the safe part of the world in fixed income is no longer safe from a risk perspective. But by way of this presentation on how to fix fixed income, we need to incorporate and understand what the world of fixed income is made of. So the U.S., not quite half. International is about half the world. Canada is about 5% of that slice, and EM is about twice the size of Canada. And then the government portion of the debt is by far the biggest slice there in the orange part of the pie. And then you have the mortgage-backed securities in the U.S. that are a big part. Corporate bonds, relatively small compared to the world. So there's lots of different ways to invest. But this is the chart that, to me, on the right, tells the story. Every bond in the world, if you weight it and add it up, has a yield to worst or yield to maturity of about under 1.5%. And the longer it takes for you to get your money back, so the slower the coupon is, the higher your risk in fixed income. It's a measurement called duration. So fixed income has never yielded lower. Okay. Inflation has rarely been higher than the nominal bond yield. So the real returns are negative. And the risk factor, the duration of fixed income, has never been higher. So we have an asset class that's possibly permanently impaired, at least for another decade or two. And even beyond that, I see the demographics and the debt problems just getting worse. I don't see a way we can grow our way out of this. And again, I could spend hours just talking about that. So why in the world today is there 12 trillion of negative yielding debt? Okay, if the global economy was healthy, this situation would not exist. And so anybody who tells you the economy's fine, I think is an imbecile, or they're looking at it in a very, very different glass than I am. Because the fact that almost 20% of the entire $75 trillion of debt in the world has a negative handle on it tells you the world is fragile. But with quantitative easing in the new world of modern monetary policy in which they monetize debt to stimulate growth, the party can keep going, folks. But when the ultimate bond market breaks, stock market breaks, and trillions come out of equities, it goes to the safest yielding asset. And today, that's the U.S. Treasury market. It's the highest credit rating, highest yielding debt in the world because Japan, Germany, Italy, like all the other G7, Canada, we all have lower yields than the United States. So if you don't think when the money comes out of the stock market, it's going to go into the U.S. Treasury market, you're nuts. And despite all the negatives about low yields, bonds will be a very important part of portfolios in the next big downturn. So we got to know what our toolbox looks like. And here's a list of ETFs in my universe, not an all-encompassing list, but it represents some of the best ETFs that I like to use across different types of bond exposures. AGG, folks, is the entire U.S. bond market, every bond that trades in the U.S. TLT is long bonds in the U.S. LQD is the liquid universe of high-quality corporate bonds. TIPS are inflation index bonds. VCSH are short-term corporate bonds in the U.S. ZAG is the entire Canadian bond market in the BMO world. And you'd say, well, why is the correlation? Because what we're looking at here in the numbers, folks, is correlation. So correlation of 1 means everything's perfectly correlated. One goes up 10, the other goes up 10. One goes down 5, the other goes down 5. They do the exact same thing. You put two things with a high correlation in a portfolio together, you get very little diversification. If you have something that's perfectly negatively correlated, -1, One goes up 10, the other goes down 10. One goes up 5, the other goes down 5. They do the exact opposite. You put both of those in your portfolio together, you wipe out your return, and all you have is risk. So those aren't good. What we need to build portfolios to reduce risk and add sleep at night is low correlation assets. And in the world of fixed income, in my world, emerging market bonds, currencies, preferreds, floating rate notes, emerging market debt, high yield, convertible bonds, and reset preferreds all offer very interesting asset classes within the world of fixed income that give us uncorrelated returns. And we have to learn how to use these in portfolios if we're going to have any success at all in the world of fixed income. So I'm going to show you some correlations. I'm going to first look at high yield in the US market. HYG is an ETF, and I'm showing you over the last 10 years the correlation with the broad bond market, so AGG in the US. And you can see the rolling correlation. This is a 2-year rolling correlation. Sometimes high yield bonds are positively correlated, sometimes they're negatively, but generally a very low number, meaning less than half. So low correlated assets are very interesting. So high yield bonds are good to have in your portfolio. Again, you just have to understand when and what the risks are. And I'll show you some examples of how to do that. Then we can look at things like convertible bonds. So convertible bonds, on the left side, I'm showing the correlation to the broad bond market, AGG. And again, mostly negative, low number, periods where there's some positive correlation, usually during periods of rising interest rate concerns. But when I show the correlations with the S&P 500 to convertible bond ETF, you can see it's very high. So convertible bonds tend to link to stock performance. So here's an asset class of fixed income that does well when stocks are doing well. So that's very, very interesting. And over the long term, again, very negative correlation to overall fixed income markets. And then finally, I'm looking at the two most polar opposite in the world of fixed income correlations, and that is convertible bonds and long-term treasuries, TLT. So I have on the left axis TLT pricing, and on the right axis the convertible bond price, CWB, and I'm looking at the correlations, and it's a low number most of the time, okay? And that makes it a great thing for diversifying and using in fixed income portfolios. So I want to introduce the idea of options. For me, folks, there's 3 ways to take a position. I'm outright bullish. I'm just long the ETF and the asset class because I like all the upside and I don't mind the downside risks between now and when I think it might hit my price target. But if I'm concerned about upside, downside, risk, and return, option strategies allow us to build exposures to increase returns and reduce risk. So I'm going to show you a little bit about how I think about this in terms of portfolios. So as we sit right now, we're looking at HYG. So I look at a chart and I go back a number of years, and for perspective, I wanted to cover the big economic shock in 2007, 8, and 9. And you can see that when equities are weak, high yield bonds get absolutely clobbered, almost to the same extent, but not quite as the equity markets. Remember, from peak to trough, equities fell 56% in 08 and 09, measured by the S&P 500. High yield bonds fell about 35%, as you can see in this graphic here. When equities were weak in 2014 and 15 into early 16, as oil prices were coming off 100 and down to the $20 area, there's a lot of stress in high yield because of that, because most of the fracking business in the U.S. was funded in the high yield debt markets. When things were bad in Greece in 2010 and 11, you can see high yield bonds, HYG, were under stress. And of course, in the fourth quarter of last year, we saw a problem in the equity markets where the S&P fell 20%. And again, you can see the high yield bonds come off in that environment. So when I look at the chart today, I see very little upside, probably capped somewhere below 90. So if I want the yield in my portfolio of HYG, which is pretty attractive right now, 4.86 relative to everything else in fixed income, I do have to understand when I add this, I got equity-like risk in my portfolio. So how can I do that today? Well, simply a covered call can improve my situation. And back in September, where I originally created this, I could go out about a year with those options and do a covered call strategy, capping my upside at either 87 or 88 cents and generating extra yield into the portfolio. So by capping it at 87, I generate an extra yield of 1.1% with a covered call and the potential to make another 57 cents because I still get profit on the underlying ETF up to 87. I must sell it at 87 if it's above that price, so an extra 0.7. So I can convert my 4.86% yield into a yield of 6.66 should it continue to trade well over the next year. But if it doesn't and goes down, I'm still better off by that 1.1%. So when I see limited upside and potential in the portfolio of any asset class, I generally want to put a covered call to improve my risk and return. And if I think it might go a little higher than 87, I could do an 88 call. I'm only going to get 55 cents, so that's an extra 0.7%. But now I've got an extra price potential of 1.8. So I only had an extra 1.8% in the other. This one I have a 2.5%. So I got to make a bit of a judgment call on where to write that option, and that's going to be a personalized thing. There's no right or wrong. The more bearish you are, the tighter to at the money you want to write your option, i.e. closer to the current price of the underlying ETF to enhance your guaranteed yield in the portfolio. I want to also look at protecting downside while still be exposed to the upside. So duration. So TLT, the U.S. long bond, and as I say, in the next recession, I think this is going gangbusters still as yields in the U.S. 10-year go sub 1% and possibly close to zero, depending on how bad that recession is. It's hard to judge at this time what the policy responses are going to be out of the administration, because by the time it happens, Trump may not be president, and it could be the Democrats. And I won't get into that today, but so with the U.S. 30-year at about 2%, the TLT is trading at around 146, 147. So if you want to own that exposure at that point, there's some downside risk. Currently, he's sitting at 2.25. So when I priced this up, early August, early October, I think it was, what I did was say, okay, I want to be long the ETF at 146. I'm going to earn only 2.06% in yield. But I'm worried about the downside. I'm worried about the downside up to a yield of about 250. I don't think we're going to see more than 250 because every dip, I think, is a buy in the market. So what I would do is I'll buy a put protection right through the next election. I'll go out to January of 2021, and a 146 put would cost me $9.80. And you can see the table here of how those puts and calls were priced. I think at a maximum between now and then, we're going to see about 175 in terms of the U.S. 30-year. Could be as low as 150, but I'm judging 175. I can write a call at 151, which would be approximately 175 in yield, and I would earn $5.80. That would pay for a big part of that put protection. But where is that support level? Again, 250-ish on the 30-year. So 134 put would cover me at 250. I'd earn by writing that put $3.80. The entire strategy cost me a net of 20 cents. I can earn an additional 3.3% in upside potential, but here's the more important part. I've got no loss on the first 8.5% of price risk, or approximately $12 in the portfolio, because I've got put protection from 146 down to 134. You've always got to compare these strategies with just buying and holding and doing nothing. Okay, so if you want the long bond exposure and you bought it without doing this option strategy, you'd be in a position today where we're approximately 139 on the ETF, where you're offside $7. You're still earning your yield, but you're down $7. If we had the option strategy on, that $7 would be protected by our put structure. Okay, and we still have the upside potential. Looking at the next scenario, bringing currencies into this. Again, in early October when I priced this up, the British pound ETF FXB trades in New York, was priced a little under 120. So I think there's a double bottom pattern there. I like the risk return, but how do I play this? Well, I played it a couple of, I went a bit long and I did some options in my strategy, but I think it can get up to 130. We're getting close to that today in terms of the ETF potential. So I bought a 120 call for 380 out to March. I sold a 130 put to help pay for that, bringing my cost down to $3.30. But at 116, which is the lowest this ETF has ever been at, so the best level the British pound has ever been at, you can see where it got to post-Brexit and then very recently as we were worried about a Jeremy Corbyn government perhaps in the UK and a hard Brexit scenario. I'm comfortable buying 2 times the units, the exposure to the British pound at the best level ever. And I would get paid $4 for that. So I now have a structure where I'm earning an extra 70 cents, which is an approximate earned yield of 0.6%. I can leave my money in a money market ETF. I like to use SHV in the US, and I would earn, well, at that point, a 2% yield. Today, it's less than that because the Fed has cut rates. But I'm going to earn about 1.5% in yield between early October and March. So that's not bad for about half a year. And I've got the potential to make about 8.5% in terms of capital gains, seeing the British pound go from 120 to 130, and we're well on our way to that. So how's that? How cool is that? You get paid a nice yield, and you're waiting to make money on something else, or you get to buy twice as much at the best price ever. So this is why I really, really like option strategies. I think they're very, very attractive from that perspective. On the gold side here, 3 different ways to play gold with ETFs. GLDI is a bullion ETF that has a covered call strategy using futures to generate extra yield. GLD is the pure play on gold bullion, and GDX is gold miners. So I wouldn't necessarily recommend GDX in a gold portfolio because it's equity, not bullion. But by what I wanted to show you here in the graphic is the price performance in percentage terms of those 3 ETFs over the last number of years. So when I printed this out in early October, gold was at $1,500. I went back to say when was the last time it was at $1,500, and you can see that was in 2013, and showing you the exposure in terms of drawdowns, percentage losses in this case, of the 3 ETFs. And what we can see is when gold is rallying, gold bullion gold equities are the thing to own. So if you're bullish on gold, hold gold equities. GDX is my preferred way to play that because of the optionality that we can use in portfolios. There's virtually no option exposure here in Canada. So all this stuff really needs to be done in the US, not in the Canadian dollar accounts. And so there's your example. And now when you want exposure to gold and gold bullion, but you're not necessarily sure on the upside relative to the downside, GDLI might be a better way to generate some yield off gold while maintaining exposure to the underlying asset class. So unfortunately, and perhaps fortunately, fixed income is broken. I want you to start thinking like a hedge fund manager when it comes to fixed income, about market neutral investing, being long and short. So you can now play fixed income yields going lower by being in a TLT, or going higher by being in a TBF, so duration. You can play credit spreads, i.e. a high yield, doing better with HYG, or an inverse of that with SJB. And so ETFs allow us flexibility to get exposure to all these asset classes. Listen, forget trying to pick individual stocks and bonds and which company is going to do better. Just understand the asset class and how to use it in a portfolio, and you'll have a much better long-term experience. And learn how to use all these things in portfolios. And finally, a little bit use of leverage is a good thing. And so margin accounts I'm okay with. This example here uses equities, but it applies to fixed income as well. And for my sleep at night portfolios that we run for our internal clients, we don't do this in the BMO portfolios. We use a little bit of leverage. We call it a 130-30 strategy, meaning we're long up to 130% of things we like versus short 30% of things we don't. Credit Suisse issued an ETF a decade ago, and they're one of the better companies at picking stocks. And what I'm showing you here in this ETF is a strategy that's long 130% of the stocks that they have buy or overweight ratings on, and short 30% of the stocks that they have sell or underweight ratings on. And what you can see there over time, basically, versus the SPY, is that they're basically even. Sometimes a little bit better, sometimes a little bit worse, but basically even in terms of their performance. But what I'm showing you here is the volatility. So using a little bit of leverage does not necessarily increase your risk if you use it prudently. And so finally, here's the portfolio. That was the snapshot a few months ago. It's slightly different today. I didn't talk about a lot of different option strategies, but convertible bonds, I'm actually short right now. So I'm long a put out to April, a 52 put. I've written 2 times as many 53 calls, and I'm actually happy being short convertible bonds if they should go higher in price, currently trading at 54. So I'm short convertible bonds at this point. But I've written twice the number of puts. So this is called a ratio put. So I'm long a put at 52. If it goes to 48, I'm going to actually cover my initial put and then get long, and I'm happy being long there. So basically, I'm long at a lower level, I'm short at a higher level. That option strategy combined is yielding me about 1.5% into the portfolio over a 6-month term. So I'm generating a bond-like return. I'm short if they go higher. I'm long if they go lower. I just love the strategy while I wait for things to play out. Emerging market local currency debt is something that I'm adding to the portfolio. It's the highest government bond yield in the world. It does come from emerging markets. So you have emerging market currency risk in these portfolios. But over the last 5, 6, 7 years, emerging market currencies have got absolutely destroyed as money has gone into the U.S. market in a big, big way. And I think many emerging market currencies are actually pretty cheap at this point. And it's the highest yielding government bond, a little over 6% right now. So it's a very, very interesting ETF. So I have an option strategy. And in October, I got put at 34. It's currently trading at 33 and change. I don't let the price volatility worry too much about. Again, I like the asset class. You can see how we're sort of playing the British pound there by being long a little bit, and we have some put protection to protect the downside. That put protection from 118 to 114, you can see I'm going to get longer if it goes lower. That put protection cost me nothing because that was done at a net credit to me actually. And I've got called away at 127, which is almost where we're trading at today. In terms of the long bond exposure, I got put the long bonds at 138 recently, or sorry, that would be this month. If it gets below 138, we're trading right about that price. We didn't get put in October with those options, and I've got calls. Should the equity market falter, I'm going to make money with call side spread on the upside in playing duration here. So lots of interesting things we can do in portfolios, but I think you do have to think a bit like a hedge fund manager. I'm going to take the last 15 minutes here and do questions. So I'll run through them quickly in no particular order, and as I see them on the screen here. What's XGD TO to play gold? Basically it's the same index as GDX. Because I use options, I like to use the US versions. I have no difficulty at all holding XGD. You might want to look at the BMO ZGD. It gives more weight to the intermediates. And so you get more leverage to the upside if you're going to be right there versus the market cap weighted way to play gold. Let's see what else we have here. What does monetizing the debt actually mean? What it might mean for the average citizen and investor? So Derek, it's a good question. Monetizing debt means simply the government's printing money. It's QE. It's a permanent injection. So follow the flow of money. Government issues a bond. So Trudeau issues some debt. He's running deficits to do whatever he wants to do here and give money away to the rest of the world and so forth. I'll try not to get too political, but I'm not a fan of a lot of his policies. So he's running deficits. He's running deficits at a time the economy's pretty strong, theoretically, and he should be running surpluses and paying off the debts. But nevertheless, running deficits and never promised to balance the budget. that he said he would. But so he's running deficits, and so they have to issue bonds, and so those bonds get put into the marketplace. And if the Bank of Canada wants to inject cash into the system, it'll go find those bonds and whoever owns them, and it'll buy them back, and it'll replace those bonds with money. And literally, the central bank can print money. It can literally print money as in terms of paper, or it can create electronic money. So in the case of the Federal Reserve System, it goes to all the banks, J.P. Morgan, it goes to all of them and says, we're buying $100 billion worth of debt this month, and we're buying this bond, this bond, this bond, and this bond, and you're obligated to push them into the system, and we'll give you your cash back. And that's how they control the money supply. So in the future, the money supply is going to be controlled by either QE or government simply just printing it, some combination thereof. So hopefully that answers your question. The webinar is being recorded, hopefully, and that'll be sent out in the link to everybody else. I'm living in Toronto. You painted a very poor picture of Ontario financially. What can I do to protect myself in the future? Well, vote for more conservative governments that have more respect for the fiscal purse. I know Doug Ford, and I'm not a big Doug Ford fan by any stretch of the imagination, and did not support him in the leadership race, I might add. Nevertheless, he's governing our province. I think Rod Phillips is an excellent finance minister and will do well, but there's no chance that he's ever going to be able to balance the budget. If you took 10 or 12 billion dollars out of the Canadian economy today and Ontario balanced the budget, that's a 0.5% of GDP right away, wiping off 0.5% of growth. So how do you do that without causing a recession? And that's an inherent problem. So there's not really a lot the individual can do except for vote for more conservative governments. But this is why I say this is an increasingly difficult problem, because when a government says I want to balance the budget, and but it's going to cost, and we all have to share in that cost, and that's just politically, people don't want that. Now, ultimately, what it's going to mean is that we're going to have these really sluggish economies, and listen, we spent well beyond our means, and we've got to pay, and we pay with sluggish growth, and debt monetization, and low rates for, as far as the eye can see, and that's going to be a big problem for people. Will printing money ever cause inflation? Well, that's a great question, and so the answer to that question is very simply, when you see the psychology changing, and not until that money gets into people's pockets. So when our incomes start to rise, when they put interest rates to zero, it hurts savers. It hurts the income. So when our incomes start to go up, so if you see things like universal basic income, governments start printing money and literally giving it to people. Minimum wages start to go up. So I'm a big advocate that minimum wages need to go up to a livable wage. I think it needs to go up at probably a rate that's slightly higher than inflation. I think we do need to narrow the inequality gap. I don't think taxing wealth and redistributing it and having the government do that is the most efficient way we can do that. But there is some serious problems. The last time inequality was this bad, folks, was 1929. And it was the Great Depression that rebalanced things, but not rebalance things by lifting the bottom half, rebalance things by destroying wealth for the people that had it. And I'm not sure that destroying wealth is the way to do it. So we've got to put policies in process that will boost incomes of the average or the median, not the average. The average income looks okay because the top half's doing so well compared to the bottom half. But the median keeps getting worse. The middle keeps getting worse, and they call it the gutting of the middle class and so forth. It's a very, very real social problem that's only going to cause more and more political polarization. What else? Do you put options? Not quite the webinar I was hoping for. Larry went too far in explaining his option strategies that most home loan investors are doing options, especially if they are retired. Peter, I want to apologize for that, but there's no fix for this. Fixed income is broken. That's the message. And what I'm saying is we need to get creative to fix it. Now, I'm working with Bank of Montreal to create sleep at night fixed income ETF that will be available to users. Like ZZZD is the sleep at night dividend ETF. We're working on a ZZZF. I have no timeline on that. I'm hoping it's a 2020 story, and there will be a solution that you can buy. I understand completely that a lot of these strategies are beyond the average investor capability, and I'm sorry for that, but there's no spoon I can give you and say, here's the fix. Go buy this, and you're going to be fine in fixed income. Fixed income is impaired, and my point is it's the policies of government, of monetary and fiscal policies, of disregard for our tax dollars and everything in between that has got us to the point we are at today, and we are not going to get out of it in an easy way. And I hate to say it that way, and yeah, Larry, you're not positive and all that, and I get that. But the reality of the world as I see it is we're in a difficult world ahead of us in these terms. So if the market moves into a correction, how would ZZZD rebalance? So that's a good question, Sharon. And the answer there is we like that cycle of market emotions. Last December, when everything was panicking, we had the risk factor, the beta of the portfolio, sleep at night portfolio, up to maximum. So I will take risks, but I'll do them when the opportunity is developed. And whether that's in an individual sector, there's some asset classes now that have been relatively attractive, and we've been nibbling at. I've got small cap British stocks, so why would I buy that? Well, there's a pretty decent dividend there. I like the exposure to the British pound, and it's one of the cheapest asset classes, trading at a PE of like 10 or 11 times earnings because of Brexit. So a lot of bad news is priced in. So, months and months and months ago, when there was value there, I was buying EWUS. And now it's not as attractive, but it's still much better than other places in the world. And so I see a lot of risks, and it's very defensive, the vast majority. But there are pockets of asset classes that I like. Duration is one of them. Gold is another, where I think there's significant upside relative to downside risks. And as things move around, I love the U.S. dollar as an asset class today. Not for the yield certainly, but for the exposure as a Canadian. When the economy ultimately turns down, inevitably the Canadian dollar weakens because our terms of trade get worse in an economic downturn because of our energy being the biggest part of our trading here in Canada, and the Canadian dollar being seen as a petro currency, and energy prices falling in economic contraction is almost a certainty. So, there's lots of asset classes. We're positioned very defensively, but as things pull back, we will most certainly use opportunities to make money for investors. What's my opinion about the bubble of the ETF market mentioned by Michael Burry, and how do you protect if he's right? I have no idea who Michael Burry is, so apologize for that. But there's a lot of people running around saying, ETFs are a bubble, and I would debate any of them on any stage they'd like, because I think they're out to lunch with that opinion. An ETF is a mutual fund. It's no different. Money has moved out of mutual funds into ETFs. The aggregate amount in terms of ETFs plus mutual funds has not gone up. So the only difference is the ETFs can be traded in real time, and that they're more linked to an index than they are to a discretionary manager that is selecting securities, i.e. getting rid of some of the bad companies. But the hard reality, the hard fact is that taking every portfolio manager together, they don't beat the index over and over and over and over again. So it's ridiculous to try to beat the index on average. It makes more sense to be the index at a low cost, and then through asset allocation, figure out which asset class is going to provide you in the future the best return adjusted for risk. And I would say the U.S. equity market at 20 times earnings on a trailing basis and 18 times forward is not going to be attractive over the next couple of years compared to, the last few years, compared to places like Europe, where there's some fabulous dividend paying stocks. They're trading at 12 times earnings, and you can get a covered call overlay in a ZWE, for example, and earn a yield 6+% with half the risk of the S&P 500. I'll take that trade every day. That doesn't mean that an ETF won't go down in a global bear market, but it's going to go down less, and it's going to give me a better yield than sitting in the S&P 500 at 1.8%. So that's how I look at the world. And trying to time being all in or all out is far too difficult. Anyways, folks, we are coming towards the end of the time session here, and I know a lot of good questions came in, and unfortunately can't answer all of them. But thanks for tuning in, and it will be out on replay. And one final ask for you guys is, if you've enjoyed it, if I've added value to you over the years of watching Berman's Call, please click on one of the links and support either leukemia research and cancer at Sick Kids Hospital, or dementia and Alzheimer's research as we age as a society through the Baycrest Hospital. Thanks very much, and I'll look forward to seeing everybody back on BNN in the new year.